Hey friends, Dan Passarelli here. How are you feeling today? I hope you are feeling great, like Tony the Tiger says. All right. First, I want to make sure you can hear me. If you can hear me, please make your way on over to the Q&A box and just let me know you can hear me. Will you please, excuse me, do that? Hey, Jan and Justin. Natish. Anybody whose names I pronounce wrong, let me know. Except Tomas. Tomas is Tomas. Tomas is always Tomas. But today we've got lots of great stuff going on here today. Today we're going to talk about high leverage with low risk, which is using directional butterflies. Before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here today and every week is providing generalized information, not specific to your situation. I see some of our usual friends and family members here, but I see some new faces too, and I love to see new faces. I sure do. I love it. I can't tell you how much I love it. I am telling you how much I love it. But for those new faces, let me introduce myself. My name is Dan Passarelli. And man, I've been in the options industry for well over 30 years. Oh my gosh, do you believe that? Like, isn't it amazing how time just flies? Like, I was looking at the calendar today and I was like, what the heck? It's March. How the heck did it become March already? It was just like, I don't know. How is it March already? But how have I been in this business for over 30 years? Isn't that crazy? Anybody else been in your industry for like a long, long time like that, like decades? Isn't it weird how you think back to when you first started and all the people you met in whatever business you're in? It's crazy. Anyway, I've chronicled my travels and my learnings. I've written a couple of books. Oh, well, thank you, Natish. Oh, geez. You should get your glasses fixed, but thank you. I do appreciate that. Yeah, so I have written I've written three books on option trading. Only two are out. One more is going to be out in just about less than 2 months. Do you believe that? Holy crap. I can't even believe it myself. But my book, Trading Option Greeks, is the most well known. It's consistently ranked in the top 5 of options books. The Market Taker's Edge as well. And my new one comes out April 28th. That is Build Consistent Wealth with Options. And oh God, as far as other things that I've written, and the name of my new book is Build Consistent Wealth with Options. By next week, I should have a waiting list website ready to roll for you. So, let's see here. In addition to writing books, I do a ton of online classes like this one. Not to mention my podcast, my weekly podcast, my Substack post, my usually weekly Substack post, and lots of other stuff. I've in my YouTube channel, I've created a lot of content, and I still do. And I do that because I am a trader who puts his money where his mouth is. I started trading. I actually started trading when I was in college. But since then, I've been a professional trader on the floor of the Chicago Board Options Exchange and the Chicago Board of Trade and CME Group. And now I trade in a regular old retail account, just like you, which I do every day. I'm also the president and founder of Market Taker Mentoring, which is the global leader in option trader education. And I am a collaborator in the trading industry. I collaborate with really all the good companies out there, the options friendly brokers who do a great job for their customers, Firstrade, and some others, as well as a lot of the options brokerage firms out there too. I do that. Wait, no, the options exchanges is what I meant to say. I kind of lost my mind for a second there. But yeah, the options exchanges, I work with them too. I've worked with just about all of them. It is crazy, isn't it? And outside of options, you know, is that my life? Well, yeah, it's a big part of my life. But there are other parts of my life too that are more important, not arguably more important, but just objectively more important, like my family. I'm a family man, married to my wife, Kathleen, who many of you know. She runs operations here with Market Taker. I have my two adult children who are out of the house. They're living together. Daughter's about to graduate from, uh, what do they call it? Graduate school, to get her master's from the University of Chicago. Geez Louise, that girl is smart. And then my son, who is at Loyola Medical School. That guy's smart too. Geez Louise. So glad they take after my wife, Kathleen. And then, of course, I have my two cute little dogs. But I've locked them out of the room for right now because, they're always causing trouble. I do other things for fun besides play fetch with my dog and take them for walks. Can't say that word loud or else they go crazy. But I'm a runner, foodie, traveler, and I'm a music person as well. And those things are great. Can't wait for the weather to break here in Chicago, which we're really close to this time of the year when it's become March. You start getting excited, like, oh, I might be able to get out there again instead of sitting in the house freezing, complaining. Uh, and yeah, got some travel planned too. In fact, it looks like in about, less than a month, you'll have my compatriot John filling in, and you're going to love John. John helps me put together these classes, as a matter of fact. All right, enough about me. Let's talk about the important person here. Let's talk about you. Today, we are talking about directional butterflies, which is a big, big deal. I don't know how much you know about directional butterflies, but man, geez Louise, they can be very, very powerful. So get out your pen, your notepad. Where's my notepad? I always keep a notepad next to my desk too. Look, got my notepad here. Hope you have one, or you can be like a person who was, born after the year 1850 and you can use a computer to take notes. But then when we're done here, here's what you should do. You should go to markettaker.com, go up to the top right and click on join free because we've got lots of great free classes and such for you to continue your option trading education journey. let's talk about butterflies. What's a butterfly? Well, a butterfly is in the family of what we call wing spreads. And you'll see why we call them that in a minute. And a butterfly is when a trader buys one debit spread and sells one credit spread. Let's start out from the call perspective. We buy one call debit spread, and typically we're buying an in-the-money call and selling an at-the-money call. And then in addition to this, we're selling a call credit spread where we're selling another one of these at-the-money calls and buying an out-of-the-money call. So that is your classic call butterfly. You can do the same thing with puts, buy an out-of-the-money put, sell an at-the-money put, sell an another at-the-money put, buy an out-of-the-money put. Or you can do them iron, which is just two credit spreads, because a call debit spread is synthetically the same as a put credit spread. The objectives of a butterfly, it's really a theta trade. Even though you're buying two options and selling two options, because of the strike proximity, you're collecting theta when you do them at the money. And that's what I want to start out with, talking about at the money spreads. But then we're going to move on to the more powerful leveraged behemoth directional butterfly. So when we put on a butterfly where we're selling the at the monies, we want to profit from theta while losing little to the stock moving too much. And we want the stock to stay at or be at expiration the middle strike, the shared short strike price. So look, let's say we have a stock that's trading around 43. We buy the 41 strike call, so in the money, sell a 43 strike call, so at the money, and then sell another 43 strike call at the money, and then buy a 45 strike call out of the money. So basically, it kind of goes like this. The max loss is the premium paid, because why? Because we buy this called debit spread. So the most this called debit spread can be worth is $2, right? Because whatever we pay for it at expiration, we can exercise our 41 call and get assigned on our 43 call. So this spread can be worth $2. But then let's just say it's right at 43 at expiration. That would happen, and it would be worth $2. How much did we pay for it? Well, whatever we paid for it, if we also sell the 43, 45 credit spread, that one will expire worthless. They'll both expire. So whatever premium we collected on that just offsets whatever we paid for the debit spread. So the most we can lose is the total premium paid. And then the maximum gain, which we just cover, is the difference between either wing and the guts. And I said this is part of the wing spread family. And so, you know, if you're not familiar with that term, you might be like, well, Dan, what the heck is a wing spread? That's a weird, you know, wing. What are you talking about? Well, if you are not familiar with what I'm talking about, wing spread, you can picture this as a butterfly, whereas this is the body or the guts of the butterfly, and this is the wings. And if that doesn't look at all like a butterfly, you probably need to use some mild or heavy hallucinogenics. And then maybe you'll see it in a very colorful way, probably too, flying off your screen. No, you should not do that. At least not right now. Anyway, so yeah, they call these the wings and this middle part the guts. So the difference between the wing strike and the gut strike is $2. This is a balanced butterfly, so it's the same distance for both of them. Okay. What else? What else? What else? What else? That's our max gain. So in this case, 45 minus 43 that's our max loss. Okay. So where are our break evens? Well, the downside break even is just going to be this call strike plus what we paid for the spread. So that is $41 plus 30 cents is $41.30. The upper break even right here is just simply the high strike minus the premium paid. So 45 minus 30 is $44.70. Okay. So that's easy, whatever. Why does somebody trade butterflies? Well, because you can get very low risk with very high reward potential. I mean, you're risking 30 cents and you can make, well, let's see, that was $2 minus the 30 cents paid for it. You could make $1.70. Risk 30 to make $1.70. Wow. These are because they're so low risk with such high reward, they're pretty good for short-term speculation. Now, butterflies are best traded with less than 2 weeks until expiration at the money butterflies. If there's more than 2 weeks until expiration, you get a very low theta and you get a very low gamma, but the stock can move a lot more. So you get a low vega, you get delta neutral. So basically it's this. You have basically no prospect for profit when there's more than 2 weeks. But if the stock makes a big move, you can still lose. So it's not really worth it when you're trading these at the money ones. But directional butterflies, these are pretty magical. For the maximum profit, with any type of butterfly, where does the stock need to be? It needs to be at that guts strike, right? It needs to be at that guts strike at or at least pretty near expiration. Now, the strikes can be varied relative to the stock price. We don't have to construct a butterfly where the guts are at the money. We can move the guts and the wings to wherever we want. But the idea is that the stock still, we have a target set. We have a price and a time target. We want the stock to be at the gut strike at expiration or near expiration. Now, with directional butterflies, the price paid can be even lower. I mean, before we had that risk 30 cents to make $1.70, we can get an even better risk reward with directional butterflies. These can be short-term trades, but they don't actually have to be within 2 weeks. I have seen some directional butterfly. In fact, I know there's a lot of you who are part of our wing spread, Market Taker Mentoring's wing spread genius scanner, where it just pops up wing spread trades like butterflies and iron condors. You've seen those, right? Well, have you noticed some of the directional butterflies? Some of them are a month or two out, but you just risk so little that if you lose a small amount. And if the trade profits, you just make a mint. They can sometimes be a higher probability of success than just like buying a call or something. And the volatility and theta are pretty small concerns because you just risk so little. All right, let's talk about this. Let's talk about this here. The time doesn't always have to be 2 weeks or less. In fact, you know what? Hold on a second. I don't like that. I'm just going to get that out of there. The time doesn't necessarily always have to be 2 weeks or less, but it needs to coincide with the forecast. By what I mean is, if I think that a stock is going to go from 80 to 100 within the next couple of days, well, then my expiration date should be within the next couple of days. But if I think that a stock can go from 80 to 100 within the next month, then the butterfly's expiration date should be about a month. Make sense? The short strike coincides with the price target, which should be kind of intuitive based on the things we've talked about thus far. So let's take a look at an example here, shall we? Let's say, in the screenshots, it's not current prices or anything like that. Let's say we're expecting NVIDIA to rise in price from $186.23 to $195 by, couple 2-3 weeks from now. All right. This is an old screenshot because I didn't want to use real-time prices because I don't want you to think this is a trade idea or anything, because it's not. Okay, so how could we trade this? I mean, we could trade this a lot of different ways, right? We could buy a call. We could buy a call debit spread. We could even sell a call credit spread, or we can do this. We can look at a directional butterfly. So what we would do is, what price was that stock? Stock was 186.23. So we could set our target, $195. We could buy the 192.5 strike calls once, sell the 195 strike calls twice, so 2 contracts, and then buy the 197.5 calls once. 1 by 2 by 1. And if we want to look at the Greeks of this, which we should, let's see. What would our delta be on this? So and I'm just going to round this. So we buy the 192.5 calls. I got my handy dandy little calculator. Have I told you how old this calculator is? I bought this when I was still trading on the trading floor, which was I probably bought this calculator about 1996. How could the battery still be good? I can't imagine I changed the battery in this. I mean, the battery probably costs as much as the calculator itself. How could this still work? It just seems impossible. But it does. Okay, so I buy one of the 192.5 calls, so I get long a 32.7 delta, so 0.327 minus selling two 195 calls, so minus 0.254 minus another 0.254 plus I buy one of the 197.5 calls, so that's plus 0.194. My delta is, can you read that? 0.013. So my delta is barely nothing. It's barely nothing. But I still end up making money if the stock is at 195 in 11 days. My theta right now, and this is an interesting one too. Let's add up the theta. So I pay negative 0.199 because I'm buying the 192.5 call. So that's what I lose each day. Plus two of the 195 calls. So 0.106 plus, shit, I'm doing it wrong. So the first one actually, okay, so first one actually rounds out to 20 cents. So 0.2 negative plus 0.173 plus 0.173 minus 14.8 minus 0.148. My theta is flat at 0. I'm actually paying 0.2 of a cent in theta. But I mean, if I would buy the 192.5 calls, my theta would be 20 cents a day. So my theta is barely anything, but the magic really happens as we approach the 195 strike and approach expiration. My risk on this trade is just 24 cents, but we can make $2.26 max. Now, there's one caveat here. The stock is never right at the strike price at expiration. It never is, ever. But even if it's close, this is still a massively leveraged profit. I mean, it's close to 10 to 1, or I should say 1 to 10 risk to reward for the best case scenario. But geez, even if it's 1 to 5 and it's an okay scenario, that's wonderful. And there's a really small move required to break even. The stock was at, where was the stock again? 186.23. I mean, it just doesn't have to go down and we still break even. 180, or no, it has to go up 3 cents to break even. Right? Wait, what did I say that was? 186.23. Oh, yeah. Okay. The break even is 192.74. Sorry about that. I spaced for a second. So it doesn't, I mean, it's got to go up $6. Big deal, right? The vega of the spread is basically 0. And, that's one of these things where people end up in what I call sometimes the Vega trap. In fact, didn't I do a class on the Vega trap? Yeah, I did it about a month ago. Almost, in fact, I did it exactly a month ago. That's where you make a trade and all of a sudden implied volatility changes or whatever. And you're like, geez, what the heck happened here? I thought I had a good trade and I'm getting creamed. Here, the Vega, it just doesn't matter. And the only time when Vega could potentially get bigger is when we get closer to the strike price. But we've got to hold this till close to expiration anyway. And at expiration, Vega's nothing anyway. So, like, this is one of those trades that completely avoids the Vega trap altogether. And, that just takes away this big element of risk. um, Even a huge move in implied volatility is not going to matter to you at all. Because when it comes down to it, with butterflies, friends, this is all that matters. So we pay 24 cents for this. Now, who can tell me what the most we can lose on this trade is? Let's have a contest. Hit that Q&A box and tell me what the most we can lose on this is. While you're there, I got to turn the thermostat up. My nose is cold. Does my nose look red? Do I look like freaking Frosty the Snowman or Rudolph the Red-Nosed Reindeer? Hold on a second. Jeez Louise. I got to turn the heat up. Oh my gosh. I can't wait for this Chicago winter to be over. Makes me want to go punch a snowman or something. Okay. Natish was first. Boom, boom, boom. 24 buckarooskies. That's presuming this is a one lot, which I think is the assumption that I made. So that's right. 24 cents of option premium is $24 of real money. Natish is the big winner. Nice job. Justin just says premium paid, which is also the right answer. Jan says premium paid, also the right answer. Tomas also says premium paid. Nice work. Tomas, telltale sign. Are you from the UK or Europe? Because the 0, 24, us Americans, we like to use a period, a point, decimal point. I see these things. I notice them. It's good for traders to be detail oriented. All right. So you're all correct. Everybody's smart. Now, that was the easy one, though, because I already told you that answer. Here's what I want to know, because I kind of told you this answer, but I didn't really lay it out like super, super clear. What is the maximum best case scenario profit? Oh boy. Actually, I think I did lay out this answer, but I want to see who's paying attention. Who's going to be first over here? Natish. Boom. 226. That's right. $2.26 of option premium or $226 of cash. Jan, you're close, but this one was a little tricky because it's a $2.50 strike difference. But you had the right idea. Okay. So good job. Greg, same thing. $2.50 wide strike. So 250 minus 24. Good job, though. Good job. Good job. Everybody's got the right idea. Everybody's on the same page. At least everybody's who's answering. Some people who are not answering, hey, if it was the first time you looked at that and you don't know, that's okay. Just keep paying attention. If you knew the answer, but you didn't say anything, what the heck? Come on, beat your chest a little bit. Be trader-like, brash, and, uh, uh, you know, have some bravado. That's what our traders like to have, right? Bravado. Arr. Give those answers. All right. So, yeah, that's right. So, where was the stock in the example? Is 186. So, like, look, man, could you put together a better trade if you think that the stock is going to 195 in 11 days than this butterfly? Hey, Natish, I love that actually. Natish, I think you guys can all read each other's questions, but it says, I have bravado, but I'm invariably humbled. Yes, the market humbles us all, does it not? I would love to sit here and tell you that all my trades are always correct and all that, but they're not. And that's not really the goal of a trader anyway, is it? I mean, we wish it was. We wish every one of our trades was correct, but the market humbles us. I was just reading a book yesterday on trader psychology. Yeah, I do. I read those kind of things. Trader psychology is something that I've been focusing a lot on. That's actually, trader psychology is actually a big part of my new book that comes out on April 28th. But he was talking about how traders, how did the author put it? Basically, you're always let down on every trade because either you left money on the table or you let it on too long and it retraced. Like you never buy the absolute low and sell the absolute high. Like you're always like bummed out in some way, which is like kind of difficult to deal with mentally as a trader, isn't it? But once you've made enough trades, you realize the game is never to buy the absolute low or sell the absolute high. It's just, to get it in here somewhere. But still, risking one to make almost 10 is wonderful. But hey, even if I risk one to make 5, it's still pretty good. Or, I mean, is it pretty good? Let's compare it to other ways that we could trade this. So on top is our butterfly. We risk 24 cents to make a maximum of $2.26. So basically risk one to make almost 10. What if we would have bought the January 30? Was that the same expiration? Yeah. 192 and a half calls. Well, we would have risked 10 times as much. And our reward is unlimited. But let's look at the second bullet point here. How much would we have made if the stock closed right at 195 on January 30th expiration? If we were exactly correct, what would our profit be? What would our P&L be? Oh, dude, Natish is on fire. Justin, Natish is giving you a run for your money, man. Poof. You went from king of the hill to, a guy who's, on the hill somewhere. I don't know. I don't know. Jan, too. You're slipping, Justin. You're slipping. Got to get back at it. I know. Sometimes when you get on top, you get complacent. Don't get complacent. Good job, Jan. All right. So, yeah, isn't that crazy, man? Like, you would actually lose money if you bought the January 30th 192 and a half calls at $2.51 and you were absolutely exactly correct. Well, that's a kick in the pants, isn't it? Okay. I mean, what if you bought like the February 195 calls? Well, now you're risking a whole mess more, not even 10 times more. It's like 18 times more. And, you'd probably make a little bit of money here, but gosh, I mean, that would not end up being a great trade either. Hey, what about selling puts though? You'd sell the January 30th 180 puts. So my risk, well, wait a minute, how does that all work? What is my risk? I mean, it is unlimited, right? I mean, not technically unlimited, but basically unlimited. If this stock goes to zero overnight, you're going to feel like it's unlimited. And I know what you're going to say. Well, Dan, the stock can't go to zero overnight. Well, it's probably not going to zero overnight. Have I ever seen a stock go pretty much to zero overnight? Yes. Yes, I have. And if you haven't, you just haven't made enough trades yet because it does happen. Maybe, not zero, zero like that. All it takes like bankruptcy court and, a lot of time, but it could go from 180 to like 20. Yeah. Yeah. And that's like a crap load of money. You're trying to make $2.73 and you lose like $17,000, right? Ouch. That, my friend, is a kick in the pants. I mean, even if you lose half of that, the risk reward's terrible. And I have definitely seen stocks lose 50% overnight. I'm sure if you gave me an hour and a half and I looked back at, records and charts and stuff, I'd give you a list of 20 stocks that lost 50% overnight in the last 5 years. My mic is out. My mic is not out. Are you kidding me? Hey, give me a yes if you can hear me. Okay. Yeah, my mic is not out. You're trying to trick me, Jan. Why are you trying to trick me like that? Don't try and trick me like that. Oh, your connection is bad. Oh, goes from my fault to gotta be careful. You made me panic. I don't like to panic. Makes me nervous when I panic. All right. So anyway, the selling the put is an interesting thing here. You do have a great deal more risk, but you actually have a good deal of protection too. I mean, you end up with a profit unless the stock falls $6.23. You end up with, you end up with a, $2.73 profit, presuming that's what you sell the put at. So that one's just sort of a different scenario. But when we look at what is your, okay, so like, this is a really important concept in trading. And this is one that I talk about a lot in my upcoming book, the one that comes out April 28th, Build Consistent Wealth with Options. And hey, you might be listening to this on the archives on YouTube and it might be out already. The one thing that I talk a lot about that people don't talk enough about is return on capital. So with the butterfly here, my return on capital is like, 900 something percent potential. Realistically, since it's not going to be right at 195, it could be like 500% or something, It's very, very favorably leveraged. What's your return on capital on selling this put? That's a tough one. All right, now we're going to see who's smart. Now we're going to see who's smart. In a few words, because I know you could give me like a couple paragraphs to be fair. If you think you can tell me in a couple of words, like one sentence ideally, what is my return on risk on selling that put? My return on capital on selling that put? Hmm. It's a lot harder, isn't it? And I won't wait forever because I I know there's a lot of head scratching going on here. Yeah, so that is my yes, that is right, but I want to guide you to a different way of thinking about it too. And so I'll just tell you. This is called either a naked put or a cash secured put. Ooh, there you go. Greg, that is the answer I was looking for. Jan, also, good job. Good job. Good job. So let's assume that we're doing this as a cash secured put, which for me, when I sell puts, that's almost always the way I sell them. And I sell them in my IRA. Um, because I look at a cash secured put as being very conservative, especially when it's my objective to potentially buy the stock. If this is a cash secured put, your broker, Firstrade is going to take $18,000 because that's what it would cost you to buy this stock if you get assigned, right? 100 shares times $180 per share, $18,000. $18,000 is the money that you literally are paying to do this trade. You're not technically paying, but the cash is being locked up. It's being set aside. So for all intents and purposes, that is your capital cost. As long as that trades on, that capital is taken out of play. It's off the field and it's in the sitting on the bench. But my reward is 273 bucks. So it's yeah, 273 or yeah, exactly right. $273 divided by $18,000. So we're looking at like, I don't know, I didn't do the math. I'm just trusting you here, Jan. 1.5% versus 500% on the butterfly. So the amount of capital you tie up, it's so much better with the butterfly. The only advantage that the selling the cash secured put has above the butterfly is that you could be wrong and still make money. If the stock goes down to like 180 and a half, and that's where it is at expiration, you still get to keep that 273. So they're just different. I mean, even the long call ones that are kind of framed here as being much worse, they're only much worse if you believe the stock is going to 195 and that's how you want to play it. They're terrible if you think the stock is going to 195. But if you think the stock's going to, 220, the middle ones are way better. You just have to do some comparisons. 9 to 1 is great leverage. 24 cents is the lowest risk. The unlimited profit potential in this case isn't realistic, and it's not congruent with our goal. Managing the butterfly, we need to hold it until pretty darn close to expiration, probably expiration day, to really maximize it. If the stock falls, even though my loss is so small at 24 cents, it's barely got any delta. So like the stock could fall a bunch and a lot of time could pass and I could still recoup 50% of my very small loss. So, and if the stock rises too much, it overshoots, I can always do an adjustment and roll up the call credit spread part of the butterfly to a higher strike credit spread and roll it into an iron condor, well, into a condor. Let's look at another one. It's kind of fun, isn't it? We expect a stock to fill a gap, getting back up to about 93 bucks in the next 7 days. This prior support could be resistance, so we're not looking for it to bust much above there. We're just looking for it to bust pretty close to there. So where's the stock? Stock's at $90.25 or so. We're looking for it to get to 93. So we could buy the 91 strike calls, just a little out of the money, almost at the money. Sell 2 of the 93 calls and buy 1 of the 95 calls. Now, I'm not going to go through all the math here. You can probably do the delta pretty close to in your head. It's got just a slightly positive delta. It's just got a slightly negative theta. And rho doesn't matter. Vega doesn't matter. Gamma doesn't really matter. So we're paying 57 cents for this trade. The most we can make is $1.43 because the strikes in this case are exactly $2 wide. We don't have that 250 business. So $2 minus 57 cents is $1.43. There's a very small move required to break even. Stock is currently at $90.64, I guess we say. It just has to get up to 91.57 to break even. Wait a minute. How do we come up with 91.57? Oh, yeah, the low strike, 91 strike calls, plus the premium. 91 plus 57 is 91.57. And the implied volatility doesn't matter at all. So what does matter? Well, it's the same thing here, right? This is really all that matters. And gosh, how much does this even matter? I mean, I guess it matters a little bit. We need to know what the maximum profit is, because like if we're going to try and sell this butterfly for like, $3, I mean, it's not going to work. The most the butterfly can be worth is $2. And so for us, because we paid 57 cents, if we sell it at $2, we make $1.43. So, it's not like we're going to put in $2.50 offer. Like that would be dumb. And putting in a $2 offer probably isn't the best idea either. We probably want to put in something like $1.50 offer or something. So instead of having like a 250 something percent return on capital, maybe just 100% or something, or 150%. We could have also done this with different strike prices, and there would be advantages or different advantages. What if we bought the 92 calls, sold 2 of the 93, bought the 94 calls? Well, the skipped strike gives us a better break even and a wider range of profitability. Why? Because with the first one we looked at, 91, 93, 95, it's the 91 strike plus the premium instead of the 92 strike plus the premium. So our break even's better with the skip strike. And, you know, you could think about like the teepee, that is the guts. If it's 91, 93, 95, it's, you know, it's wider. But if it's 92, 93, 94, it's going to be tighter, which means there's a tighter range for the stock to be in and still be profitable. So let's compare them. Because one is not still necessarily totally universally better, because we actually pay a little bit more with the skip strike one. 91, 93, 95, we pay 57 cents. Where 92, 93, 94, we only pay 26 cents. But our maximum profit is a lot greater with the skip strike and a lot worse with the tighter strikes. The break even's better with the wider strikes. The range of profitability is better with the wider strikes. So, I mean, the moral to the story is when you're trying to decide which strikes to use, well, the middle strike is easy. That's your target. If I think it's going to 93, the middle strike's 93. It's just the wings that you have to choose. Prior support, well, you know, whenever support is broken, it becomes resistance. So this was support here. Now it's resistance. So, you know, we're thinking the stock is not going to bust above 93 because resistance holds, not always, but more often than not. But the profit range here is anywhere between 91.57 and 94.43. So we've got a pretty decent range that the stock can be in and still make money. If resistance holds and the stock rises some, we should still make money. If the stock breaks out above resistance, it's okay if it does a little bit, as long as it just doesn't really follow through a ton. So it's a 7 days till expiration trade. We plan to hold it till expiration day and close it that day. Close for 50% loss if the stock falls or, you know, rises like mad. So, I mean, basically we're risking pennies to make dollars, you know. The whole premise of butterflies is they're theta optimization trades, but theta doesn't come into play until and unless the stock is near the strike price and we're getting close to expiration. That's when it hits the sweet spot. That's when it gets really exciting. We want to move through our long to our short. And if that doesn't happen, okay, we lose a little bit. And if it does happen, okay, we have a really great trade on our hands. And this is the sort of trade where if you lose on 3 and make on 1, and then lose on another 3 and make on another one, lose on another 3 and make on another one, in the long run, it can work out really great. Hey, friends, I hope that helps. Next week, we've got a great class. We're talking about maximizing profits on single-legged options versus debit spreads, part 1. Oh my gosh, that's going to be a 2-part series. So make absolutely certain that you are here for next Tuesday's class. All right, friends, I hope that helps. This is Dan Passarelli. Trade smart and have a great rest of your day. See you next time. Bye.